Well, today's CPI read showing that inflation continues to moderate, helped particularly by falling gas prices. It's good news for the Fed, whose tightening campaign is reaping the desired results. But what is next for the central bank? Here to unpack this further is Yelena Shulyatyeva, economist at BNP Paribas. It's great to see you, Yelena. Thanks for being here. So, you heard the discussion we were having about the Fed. The Fed seems to be consensus here that they're done. Are they done? And if so, what then?
I think I heard a really good word that you guys used. Today's report solidifies our expectations for the Fed to be done. So we have had this projection for quite some time now. We don't see any more rate hikes, and we think the next move will be a cut, which is not coming until June in our view. So, but today's report really confirms our expectations. So even before we got today's numbers, we heard from the Fed, and we heard how their rhetoric has changed over the last several months and weeks. They became so much more cautious. Even as inflation continues to run high, they have become much more cautious, talking about risk approach, risk management when they conduct monetary policy. So I think today's number just helps to alleviate some of the concerns that the process is not going where it should. So I think in that sense, we just need to see more of the same numbers that confirm the downward trend in inflation. And that would just confirm that the Fed is done. I think also in terms of inflation and gasoline prices, you had a really interesting discussion, and I would like to contribute to that. I think, gasoline prices declined, and that's a rate of change, but gasoline prices remain elevated. And we did see, that pushing inflation expectations up, at least in the Michigan survey recently. So consumers are not happy about inflation still. And today's report showed some deceleration and some declines in discretionary spending categories. So we think that we see some deceleration, some cooling of demand for those discretionary spending categories. That tells me that we're going to see some, and I mean things like recreation and traveling, things like that boosted economic growth during the summer months. I think that is abating, and we're going to see much cooler economic growth going into the year end and into the next year. I think that particular report today is not only telling us about the state of inflation and how price growth is decelerating, it also tells us a little bit about the state of the economy and where demand is cooling. So, and I think that's a very interesting takeaway from today's report.
And Yelena, on the state of the economy, the Fed is trying to engineer this, soft landing. So, inflation comes back to their 2% target without a downturn. Does that look achievable to you, Yelena?
We are in a recession camp, although we expect a mild recession. So we only expect a peak to trough, a downturn of 0.5 percentage points. But still, we think that without some correction in the labor market, it will be very difficult for the Fed to achieve the inflation target of 2%. So we think we need to see some cooling, much more than cooling in the labor market, with the unemployment rate increase, so that price growth really decelerates to where it needs to be. So I think we are not particularly in a severe downturn camp, but we do expect a mild recession. And there are a lot of things pointing to that at this point. You see a pickup in interest rates, not spending interest rate. Consumers have to pay more in terms of interest for credit cards, for auto loans. And that increases delinquency rate on those types of credit. So I think we see that happening, and it will probably intensify over the turn of the year.
And on this point as well, Yelena, earlier I spoke to Kathy Wood, of course, founder and CEO of ARK Investments, and she talked about her view on the economy and what the Fed is going to do. I want to play for you what she said.
Now we're getting more prints again that are saying the Fed probably has overdone it. And you just listen to quarterly company calls, and you'll listen to these management teams, and we have lots of callbacks with managements, and they say, why are you the only one seeing recession? Why can't the Fed see this? This is what we're going through. And I do think the Fed is using lagging indicators for monetary policy, which is unfortunate.
This is something that we've talked about before, Yelena, with regard to the Fed. In Kathy Wood's view, we'll see margins getting hurt at many companies, and the companies that have kept employees around because they were burned during the pandemic when they couldn't find anybody are going to really start to see accelerating cuts of workers. Do you see that kind of a scenario happening?
I think that's what we should expect, and that is exactly what happens when the economy slows down. It happens gradually, and growth in payrolls follows that on a gradual trajectory. Only until a point in economic cycle when growth slows down so significantly that it triggers cuts in jobs. And this is what usually happens. So it's usually a linear relationship between economic growth and employment until it's not. It becomes non-linear when economic growth slows down to such a significant degree that companies need to lay off workers. And I think we're approaching that point. It's very hard to pinpoint, but that's the mechanism, I think. And when it starts happening, one company starts laying off workers, another company will look at it and say, well, these people are laying off people, and we have to follow just to stay afloat.
Yelena, a good reminder for folks who might be celebrating at this CP high print today. Yelena Shulyatyeva, thank you so much. Appreciate it.
My pleasure.